There we go. There we go. There we go. Wow. Okay. So sound is a thing. Sorry about this. I got the other light turned off. It's the light really affects my eyes. If that means I have to have kind of a crappy green screen, then I'm gonna have kind of a crappy green screen. This stuff is all supposed to be. It's rhetoric. We're talking. It's a conversation. This is not. If you've come here hoping to learn about trading or day trading or how to day trade, I'm not your guy. If you're interested in something like that, go ahead and leave a comment in the comment section. I will point you to some people who are really good at trading, who you can learn from. I personally don't have any results that will really work well for you as far as trading goes. But what is important is the conversation. That all being said, welcome to the Russel Journal. My name is Russell, and this is my journal entry for Monday, December 5th. Monday, December 5th, 2022. All right. So as far as today went in the market, everything sold off, was down. And something that we pointed to yesterday in the end is that the sort of towards the end of yesterday's stream is if you're looking at the 30-year yields, they were very extended off of the averages, and that they were going to have a corrective move to the upside. We hit that yesterday. Although the problem with this is it was mixed in with a bunch of other real sort of possibilities and where as to what could and will affect the market. I did not know that. I didn't know that today would be the day that the averages would correct. They were fairly extended. It was something that I saw the yield curve. The yields, especially the 30-year, very extended to the downside, needed a correction to the upside, okay? Something that's very interesting about this market right now is everything is in reaction to those bond yields. They are looking to the bonds to be the leading indicator as to what the Fed will do and as to how the economy is holding up, all right? I think this is difficult. This creates a really difficult sort of scenario for us because I don't think that the bonds care too much about the inflation number. And I don't think they care too much about whether or not the Fed is going to follow through on putting inflation back into the bottle. So that's sort of the difficult thing with it, which really brings us into sort of the point of this conversation, which is a question of time. There's so much in the market about time. There's so many misconceptions about time. The physicists out there in the world will they will have you seeing black holes and planets in place of time. Your bosses will have you seeing work in place of time. We put so much emphasis on time in for humanity. I think that it's time to wax a little bit philosophical about time, if not poetical. A few things that are very interesting about time that I think that there are those who consider time to be a resource. I am not in this camp. I don't believe that time is a resource. And the reason I don't think it's a resource is because one, it's something you can't control. You don't know how much time you have. In the long run, you try and allot time to things and use it as best as you possibly can. But when it's gone, you can't do anything really with time or you can think about things in terms of time, but usually your benefits tend to come when you stop doing things based on time. Some of my greatest financial benefits came not when I was being paid for my time, but when I was being paid for my work. Eliminating the sale of my time has typically been financially very beneficial for me. So I think that that's really where you get to. Nonetheless, we do calculate a lot of the world in time, so you can't ignore the measurement of time. Okay, and sort of the projection of where we go with those measurements of time. So it makes it very, very difficult. And when you go into something like trading, time becomes very, very important, and thinking about time becomes very, very important, and doing things based off of different times, time frames, timings. Those things really matter. Some of the stuff with inside of the market, there are the culture within the market. One of the key takeaways or key phrases from the concept of time or time in the market is exactly that. It is better to have time in the market than timing the market, right? You will see a lot of stuff if you are stepping into the world of investing. You will see the concept of time in the market is better than timing the market. If you are a guy like me, you disagree with that statement, or if you don't disagree with it, you live in defiance of it, and that's really where I am with my trading. Is everything I'm doing is about trying to defy the concept of time in the market. I am trying to be better than that. And maybe that's my ego, or maybe that's just my position in life. And it's probably a little bit of both, where I feel as though I really need to make some very drastic strides into my financial situation, drastic corrections within my financial situation. Those things are definitely there. Somebody who has sort of lost 20 years of my life to to pursuing the wrong things. I'm definitely looking to hit that windfall, that leg up. That is something that I am personally trying to do. It's not that it can't be done. It is very hard to do. Hail Marys are Hail Marys, and they the name of the game for football is football. It is not Hail Mary passes, right? You will see more blitzes and more guys pushing for a few yards at a time than every pass being a Hail Mary. And that's because the Hail Mary, when it works, is awesome, but it very rarely works. So a lot of my life right now is really focused on dialing in that Hail Mary. The good news is, for it to work and for you to win the game, you only need one Hail Mary to work, and it will win, and you can win the game. So that is a lot of sort of what we're looking at and we're driving at. And one of the things you'll find when you step into this world of stocks, stock market, equities, money, things of that nature, so you'll find two very different philosophies that are meant for two very different times, right? So the very first one is the rules for staying rich, and what you will be given if you follow much of the guys like Dave Ramsey or the Susie Ormans or most of these guys is that especially you're finding even your Warren Buffetts or your Warren Buffetts or your Charlie Mungers or any of these guys, is what you will get from them are a lot of the rules for staying rich. Okay. You're looking at people who stepped into the limelight the decade after they took all of their risks. Okay. Even then, and you will see guys who are really, if you look at somebody like Elon Musk, who has been rich many times over by following the rules of not staying rich, but more or less following the rules of getting rich, okay, or building wealth. Okay, you're looking at guys who really are, and you can see the contrast in views there. You can see how Elon Musk continues to swing wild, right? He continues, and he does it in the name of innovation. And you're looking at a person who more or less is very interesting, because the guy does not seem to care about money. It somehow, some way, money is not a problem for him, and he has essentially what is fuck you money. So I would imagine that he doesn't have to really give a damn, right? And so with that being said, again, the rules for getting rich versus the rules for staying rich constantly put up a contradiction within in markets and market time. Okay, so if you're a trader, you are looking to do something with time and a small amount of money. Okay, and you are really using that time in order to take a small amount of money and generate an okay amount of money. You are somebody who is trying to figure out how to, especially if you're in my world, you're somebody who's trying to figure out how to take $1,000 and turn it into $100,000, or how to take $5,000 and simply generate something like $300 a day, something along those lines. Not that you're even trying to pool up that money, but you are trying to figure out how to take a smaller amount of money and generate a far more substantial return than just traditional investing. Okay, now most people, and I could easily be most people. I'm definitely not special within the realm of this. Okay, I'm definitely not special within this sort of realm. But where you are with it is that somebody somewhere will try, and somebody somewhere will figure out, and some people have figured out how to play the system in a manner that does take a small amount of money and generate that income. For myself personally, one of the challenges that I struggle with is, what is the size of that nest egg, right? So where I have a problem is, can I take $1,000 and generate $300 a day? You can. It's very difficult. You have to be very, very, very accurate and very, very lucky with your trading in order, it would seem, to make that happen. How about $5,000 a day or $10,000 a day? As of right now, from what I have seen, somewhere between $25,000 and $50,000, especially if you're trading the style that, if you are using options in order to do this, that seems to be about where I line up with all of that. That's something that I'm beginning to see, is that somewhere between 25 and 50,000. Not that it couldn't be done. I know, especially guys who do futures and futures contracts, they tend to they don't have to have more than, like, say, 5,000 in order to do that. And a lot of that has to do with the pattern day trading rule, which is it is exactly what it seems, and it fits this conversation very well, because it's a question of time. It's the number of trades you can place within an amount of time, an allotted amount of time. Now, it doesn't matter relative to margin. You will have a lot of guys in the comment section here will talk about the pattern day trading rule and say, well, it doesn't matter if you have a cash account because you're not using margin. And while that is true, even a cash account has its limits. Say a cash account with a value of $1,000, you can use that $1,000 typically once, and then you can use it typically twice. But and you can do it 5 times a week, but you can recycle that $1,000 only 2 times. And if one of those trades is a losing trade, the next recycle is a lot less. You begin to sort of lose a big chunk of your capital, which continues to make it even harder and harder to be consistent and to scale, right? So when we're talking about time in markets, it really matters. There's a lot of things that happen around time, on time, in time, okay? And there are things that happen when they're not on time. They tend to give us some signals as to what may actually be coming or what may be actually happening, and it's usually our biggest indication as to something like a bull trap or a bear trap, and we will go and we will look and we will see today. I will show you one where I think that there is a trap setting up here. But it will be very interesting to me to see this happen if it does play out the way I think it could, or the way I've seen it play out before. So we're going to go ahead and jump into the charts and talk about and get some examples of time and where it seemed to, I wouldn't say stand still, but time definitely changed and matters. Okay. So going over here to the charts, we are on TYX over here. The reason TYX matters, this is the 30-year yield, and this is something, again, this is today's candle right here, and something I pointed out yesterday was that you're way off the 18-day moving average for TXY. There should be a correction back towards that average at some point, and you are fairly well extended off of it by 2 points. Okay. And so this is something that has been, and you've been extended off of it for a very long time, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. You had 10 days here, and then you tried to correct. You had your corrective move back down here. Definitely see pattern right in here, which is very interesting for this. Now, again, these other bonds aren't going to they're not going to matter as much. One thing I want you to understand is, even though this is down for the day, this is, you just have the screen. It's going to make your bonds down. Okay. Your bond, as the value of this goes up, right, which it did today, it's going to make the value of your bonds go down. So you're going to have some selling off in all of those things. The other thing is, again, this is really where a lot of the focus is. And I'm beginning to think that might be one of the reasons why you're not getting these really things out of the VIX that you normally get. Again, there's nothing to suggest here that the VIX is going to go on an upward, we can hear our trend is lower lows, lower highs. It's almost a vertical drop through here. Little bit of like volatility, but volatility is really being suppressed through all of this, and you're substantially embedded in. You're really embedded in this thing. One thing that some guys will point out to you, if you notice down here on the slow stochastic, if you see this low over here and this low over here, one of the things you'll notice is that this low on the slow stochastic correlates with this low right here. Okay. And the next thing you'll notice is this is a lower low right here. But if you're down here on the slow stochastic, this is a higher low than this one over here. Okay. So your chart made a lower low, but your stochastic made a higher low. This is what you call divergence. And one of the things that's interesting about divergence is it tends to show something is setting up. It tends to show that. So if this is the VIX, right? The bears on the VIX have been in control. Okay, they've been running the show, but this typically shows that they're starting to lose that control. Right? Sellers are VIX volatilities are starting to lose control of this, and that the bulls are starting to move back in. So you're starting to see some uncertainty and some creep back into the market. The VIX can oftentimes be seen as the fear index, but it's mostly just called the volatility index. And it typically does run it runs an antithesis to the market. If this goes up, the market tends to go down, but volatility can work in both directions. You can have a spike in the VIX of incredible volatility, and that volatility in the S&P or the Dow Jones can be in the upward direction. Okay. Now there's a couple of things we're going to go over to the Dow Jones, and this is something that's interesting. I want to see is the Dow Jones has been leading the entire market higher. It has hit bull market territory. It cracked that. That is really good. Now, for those who follow sort of Elliott wave principles, right? 1, 2, 3, 4, 5, kind of up here because that. So that can't be Elliott wave. That's got to be 1, 2, 3. So this can only be the third wave. This can be an ABC wave if it's only that, but it could be a fifth Elliott wave. Don't ask me a whole lot about Elliott wave. I don't know a lot about it, but I did see that, and I thought, well, that might be interesting to count that. It looks like 1, 2, 3, 4. To be honest with you, if you're asking me on the daily, you got 4 peaks in there. Is what it looks like to me. With 1, 2, 3 lows. Yeah, 4 peaks, 3 lows. And then this would be your fifth low. Okay, so some of the stuff that's very interesting that is pretty cool. One, slow stochastic gave up the overbought reading today, the bullish embedded overbought reading. And it looks pretty healthy though, right? You got so back over here. Oh no, there it is. So it made a higher high and a lower low right there. See this? This is your divergence that happened between this peak and this peak, right? This one is higher than this one. That was your divergence. That pretty much probably signaled the end of your trade at that moment. If you were long and probably coming out, you lost. You got below this 80 point. And so really, again, where it tends to come is to this here. Is this the beginning of your bear leg? I think that that's going to be a hard question to answer until you get below 18-day moving average. Okay, that is really where you're at. If you come in here, we turn on our Bollinger Bands, we can see where the resistance has been. Resistance has been kind of up here close to this upper Bollinger Band. You started running out of steam. Now, does that mean we are over? Does that mean you can easily put in a higher low situation here, go high? But with these bands right here contracting, right, they're starting to like come around the mark. I would say right now, it's probably not. There's probably better chance of like getting going back to retest new lows. But for the Dow Jones, there'll be a lot of very interesting stopping points along the way. Some of the stuff that's really interesting is if you see like this, how like where the Bollinger Band lines up with other peaks, you could easily have this come down in here, build out some type of head and shoulders pattern. But more or less, I don't know. If I was a guy shorting this and I managed to get short in here somewhere, I'd be targeting this lower Bollinger Band at 326 in there. But I would be coming out pretty fast there. I wouldn't be coming out hoping. I wouldn't be holding there hoping to get back down to this low over here. As far as that goes. But we will see. And again, a lot of it's going to have to do with some of the other stuff we talked about. Don't mind this line right here. That is, I put that up there so that when we go look at some of the shorter time frame charts, we can have some stuff. Again, looking here, you're in the bull trend. You're still bullish as can be. You got your pullback to the 18-day moving average. Notice how, something, again, that IRA teaches, you lose this embedded reading and boom, you're right back there to it. The good news is that 18-day moving average is pretty close to that $400 level. So there's a pretty good chance. Now, what we're going to do, the question here, again, going into the rest of the day and rest of what we want to talk about and how we want to wrap this up is talking about time, okay? And really, each one of these candles is a representation of time, right? So what time am I making my decisions on based on the chart, right? Where's the time? Okay. Again, you can see right of this vertical right here is today's price action. I'm going to go ahead and turn off the Bollinger Bands, and I'm going to turn off the MA. You'll notice that, you were pretty much able to get short almost anywhere in this market as long as you did it before here, this spot. You would have made money. I actually only shorted like a little bit here, like $3 or $4. It was not a lot of money, but it did put my account up 3% for the day. Given that I'm trading very, very, very small, like right now my buying power is only around $50. Even a $3 win with $50 buying power is, that's 6% almost. So, as far as I'm concerned, that's fantastic. I probably could have held out for 10% of that buying power, but I'm not willing to gamble right now, and I'm not willing to go too crazy because I have some sensitive financial stuff I can't just do. Anyway, that doesn't really matter. The question here is where did we actually see the break? And the sad truth of the matter is you didn't see the break coming on this chart, right? Where the break, you would have seen it. You got this gap down from last Friday into today, and that really signified your sell-off. And what really let that happen, go here, okay? We go back over to TYX, okay? Going back over to TYX, this is what you'll notice. This ride up here, okay, on any of these time frames, it really respected this, right? The sell-off today really followed the rise in the 30-year yield, and you can probably go to the 10-year yield and some of the other ones, but it's very easy to see this rise up here. Go back to SPY. Pretty much this whole sell-off here, they very well correlate with each other. And the other thing that I think you'll find very interesting is this started coming up, and if we go back down here, this started coming down. Okay, and so again, the bond yields do tend to want to favor the idea of a pivot. There are guys who are, and there are guys who probably have acquired a massive amount of bonds at the higher interest rates, but they're equity traders, right? Like they really they're not going to hang around waiting for those bond interest payments. What they're really looking for is those yields to fall, and that makes the equity value of a bond with a higher interest rate much more valuable. It's a trade sort of thing. If you're interested in learning about bonds, I highly recommend you watch Steve Van Meter. He definitely has the best stuff on that. But for the most part, the thing you should know is the higher bond yields go, the immediate value of bond equities goes down. Okay. And then when those interest rates or those yields come down, that makes the previous set of bonds sold at a higher interest rate, anything bought at a higher interest rate, it makes their equity value go up. Okay. So they have this sort of inverse sort of thing happening. And really one of the things I have not been able to really answer a question on for myself is where the heck which one of these charts is really the master chart. Now, as far as I can tell, the daily is the master chart. Okay. This should dictate pretty much everything you do within a given day. The daily trend tends to be the best. Okay. And where that is. From there, placing a day trade then off of that becomes really, really difficult. And there's some stuff that, and again, if say on the daily time, right? And let's go turn on the MA. Where you really looking to get long this market is, hopefully you get some more selling, you get down into this 397 area. You really want to get in there and then take your long position. And the good news about that is you can do really well because you can set your risk, right? Your bull trend is intact as long as you hold this spot right here, right? Your risk reward is pretty good on the bull trend. If you're trading the bull trend, this 393.59, and you can even tighten it up if you want. You can play pretty tight stops, or you can even use the 18-day moving average as your trend, as your risk level anyway, right? So you can get long kind of coming into here and using this 397.70 as your risk level. Okay. There's nothing wrong with that. Now, and so really, yeah, make sure buying is in there. You can set your line up right here. We'll set it up down here, right into this, right? And then we will set up another one. Do this so that we've got our risk, right? So you're playing really tight here. We'll set that there. Okay, now let's go back over. Let's look at something like the 5-minute, okay? So you could probably pretty easily, like that'd be pretty fit. Take a long entry off of here. The problem here, and this is where, if you go back to Friday's video where I said it really does look like kind of an MC Escher drawing. You can see you've got lower highs, lower lows, right? This is, you've got a downtrend on the big time frame, the longest. If we go to the weekly, right, we can see, oh, you're in a downtrend. If we go to the daily, you're uptrend in a downtrend, and then go over to something like the 30-minute. Inside of that, you're also an uptrend. You're also in a downtrend into an uptrend, right? So it becomes really, but again, risk reward here would actually be pretty good. You're looking at about $100, and not even that worth of risk at this level. To be 50. I mean, if you're playing at the money, you're 50 and be 41. So you'd be $91 total worth of risk into any one contract at the money, to get, all the way back to 410. So you're $91 and you're 10. So that should be about 500. Yeah, I mean, you got $600 worth of upside versus $10 or $100 worth of downside. And you could even play this a little bit differently where you go back and buy 110 calls, right? Out, buy them out of ways. And then you could even hedge them against each other. Let's get rid of these for right now. I'll put them back tomorrow. Turn on the Bollinger Band. Bollinger. You could hedge, at the 379 puts versus 410 calls. That's not a bad move right there. Those would all be pretty cheap. So you could play the strangle as long as you buy with enough. And this is where, again, we'll pull up the option chain here. This is where you really need to focus on time. Again, this is where we're talking about time. Everything has that sort of, let's do January 6th. That's not a red date. Yeah, your premiums on all of these are really too expensive. That is something that I think is interesting. Let's go to December 9. There you go. I mean, and this is going to come down tomorrow too. For December 9th, get the 410 calls, $1.60. Oh, geez. So the put side is definitely way cheaper. You know, you could play that 379. Let's go down here, see real fast. All right. Well, nobody's really watching this, so I guess I'm going to wrap it up, I think. If I had some viewers show up, I would go through and plot out some of this strangle type stuff. All right. So that's kind of, again, that's my conversation about time, time in the market, the complications with that time. The Russel Journal's written, edited, hosted by me, Russel Liss. We're produced for social media shows. Our executive producer is Pureza. And until tomorrow, I guess, pretend I said some sort of catchphrase.